Biggest day of the year tomorrow. We have the S&P that was just sitting in a little range here as we're waiting for CPI, which is probably one of the most expected releases that we've had all year. And it's a really big one for a number of reasons. Fed funds remains elevated over the 2-year, which is causing great pain for the banks. CPI can affect this, and we'll explain how. One clear sign was Homebuilders actually breaking out today of this little formation off support. Why that's happening ahead of CPI. Key levels on all the indexes that we're going to have to go over, specifically the NASDAQ and how we're wedged in here. We're going to discuss how to play this tomorrow and what sectors should have the most volatility depending upon which way CPI comes out. We're going to cover a number of stocks, including why SYM hit an all-time high today, and why Weight Watchers can still double even after being up 58% today. What smart money, dumb money is telling us. And finally, what is equity risk premium and what is it telling us right now? Hey everybody, welcome back. Today's video, we're going to be going through some of the news that obviously hit. We're going to talk about CPI in great detail, but I really want to get into these key levels. We're going to have to watch that. That's going to be one level we're going to watch tomorrow. And we really got to talk about CPI and what to expect and then what we should be doing about it. And let's get into that now. But I want to watch this 41.26 and this 41.45. This is investing.com. It's a free site. And what I want to do is just walk through what the expectations are so that we know how to prepare. So there's a lot of data coming out tomorrow, and CPI is not the only thing. So let's dive into this. Core CPI, we're looking at 0.4 is the forecast versus previous 0.5. If we take a look at our core consumer price index chart, you can see the levels right in here and how we have been dropping down on core. Core is X food and energy, meaning they are not included. And you can see how we're starting to rise again in here, how things are starting to pick up again. And that is something that is becoming a concern for people. And there are some analysts out there that are actually suggesting that core could pick up tomorrow. So this is something that we're going to want to watch. I don't like the fact that if we look at the numbers that came out February and then you get into March, that we were actually above on the forecast. So it does bode that there is some credibility to what they're saying. Now, if we dive into year over year, 5.6 versus 5.5, this is where it gets interesting. Because even if you're at 4% versus the 0.5%, you're going to get a very different number here year over year. 5.6% versus 5.5 year over year. Now, what is somewhat troubling about this is we can all see the decline that's been starting since October, which was the low in the market when we were at that 6.6 level November, and how we just came down the entire time. But tomorrow we're looking at 5.5% is the number to beat, and we're looking for 5.6. Well, this would be the first uptick year over year in consumer price core since October. That's not going to be ideal if that's what happens. So the number one thing that we want to see tomorrow, the number one thing you want to see tomorrow is you want to see under 5.5. If you see under 5.5%, then you can expect that equities should be more bullish, but then you still have the other numbers that we're about to get into. But I just want to point out a significant difference here so you get this before we get into the other data. If you take a look at 5.5, 5.6, you can see core CPI and 0.5, 0.4, you're not really slowing at the same pace. Look at year over year, 6% to 5.2 when it includes energy. So if we take a look here at these numbers, you can see it. 9, 8.5, and how you dropped. And now you're at 6, and we're looking for 5.2. So we're starting to see some sticky inflation. Now, sticky inflation is things along the lines of, think of it as a subset of goods and services. And they change, but they take a long time for them to change. Therefore, they call them sticky. For example, you may think rents are going to drop, but then it takes a long time for rents to drop. You might think healthcare costs are going to drop, but then they don't drop right away. So this is the max from 67 to date. We're just going to drill out 10 years so you can see where we currently are and how off the rails we actually are on sticky inflation. Now, the issue that we're running into is that you're starting to see this still stay up here. Okay, we're not really dropping. A matter of fact, if you take a look at the sticky number from January, 6.55, and you move it to February, you're at 6. 0.59. Okay, so you're actually getting higher. And that's not what you want to see. You actually want to see it going down. So it's going to be a really interesting reading. And this sticky price is really tied to the core. But we want to understand that this actually has very different components. Not all the components are the same, but you can see how we've hardly dropped here the entire time. And this is becoming an issue when people say inflation stays around longer than expected. Now, if we take a look at the month over month and we're looking for 0.2, that is a substantial drop in just CPI month over month. Anything that is higher than 0.4 is going to be a problem. But you can see how we've just been falling off a cliff here. And really, it's the direction. So the issue is really going to be core. Now, the issue is not going to stop there because you have FOMC meetings that will be released at 2 o'clock. The good news about this will flow us right into PPI the next day after having the FOMC minutes and the CPI data. So the focus tomorrow, and I really want to hammer this point home because this is really about CPI. We're going to go through a lot of names. There's two very specific charts we must cover tonight, but I really want you to understand this. It's all about CPI. And that's what's going to change the entire technical landscape tomorrow. So as we can sit here and we can talk about this doji and that doji is a sign of uncertainty, quote, it is a sign of uncertainty. Spoiler alert, it's uncertain because you have CPI tomorrow. So we knew that before we had a doji, right? But I do think you could have a massive push tomorrow. I think people are way out of position here. And I really think you could. We were talking about this in the Alpha Chasers community. You actually have the single largest short position since 2011 on the market right now. You have the most net short in semiconductors that we have been in 5 years, meaning hedge funds are the most net short they have been exposure-wise to semiconductors in 5 years. Do you know how that's going to go when they start realizing that they might be out of position? I don't think people truly get the amount of money that's actually on the sidelines. And we went through that. If you remember in the previous video, we went through the margin debt as a percentage of growth. We're going to go through that chart again while I'm thinking about it so you can understand where my head is and how I'm looking at this. Our focus tomorrow is that CPI number, that core CPI number, and we'll be live for it tomorrow. But I really want to hammer that home. People are way out of position if this number is decent and shows that they are going to maybe raise 25 basis points or maybe not. Now, let's deal with this first. This is the equity risk premium in the marketplace, okay? This is 10 years. And really what this does is this little line shows, is it a good time to buy stocks versus bonds or a bad time to buy stocks versus bonds? Think of equity risk premium as basically they're taking the earnings yield of the S&P and they minus the 10-year yield against it. So at least you know what you're looking at or have an understanding of what you're looking at. But when you are high, then you are in a position where you have high equity risk premium, right? That's what you want. We don't have that right now, and that is an issue, and I do want to point it out. We're still under here, meaning when you start looking at buying bonds and you realize that on like a 3-month that went off today, or you start looking at a 2-year and you realize that you're still getting 4.6%, and that's what we were talking about, that curve and how that curve could be affected. But you start really diving into this and going, okay, let's go out 20 years. When was the last time we were like this? Well, we were like that here, right? I have to move this one over. And we were like that here. Well, they were both bottoms in the market. This is where we are right now. We always have to look at the good and the bad. We can't just look at the data points that we want, right? It's confirmation bias. So when I look at this, are you getting paid to buy equities right now versus bonds? And as far as risk tolerance to something that was at a low? And the answer is no, you're not. So we just need to be aware of where we're at. Just like when we looked at that bear market volatility index. Now, a lot of things can change. You could have earnings spike. There could be all kinds of things that could actually offset this. I know we don't think that's possible, but there are all kinds of things that can offset this and change that dynamic. Realize if the front end of the curve rallies, this dynamic will change, right? If the 10-year drops even more, this dynamic will change. We should focus on margin debt so you can understand where I'm going with this. So this is New York Stock Exchange margin debt. And you look at the level on where they're currently at for the entire exchange, right? And you're nowhere near where you were. You're actually back to levels that we've seen before even the pandemic. So all that has come out of the market, meaning all that froth of margin and borrowing on margin, it's all essentially out of the market. if you just took a line from the top here and you drew it straight across, you can see very clearly that you're pretty much lined up, right? So that would mean that all this move and all the froth on the margin is pretty much out. Now, to hammer this point home on how much froth is really coming out of the market, the 12-month rate of change will show that not only in an absolute value are you back to these levels, but on a relative value based upon percent of growth over a 12-month rolling, you're at trough levels. So if we zoom out and we look from 1952 on, and you look at the last time that we were at a position where we were this low, we've only had it a couple times. We had it in the 70s, which actually is very similar to the kind of market that we're in right now. And 2000.com boom is when that blew up. You can see where we were there. And then obviously the great financial crisis. But what we're seeing here is we're seeing a level that is telling you that based upon the current economics and the current growth of what's going on out there, meaning market economics, I should say, or market internals, the amount of margin is very, very low. So if any good news comes out, any good news at all, people are going to increase their margin. And I'm not talking about the retail investor. So look at smart money versus dumb money. And as everybody knows, we don't really call it that here. We like to refer to it as institutions versus retail. And then you have the hedge funds that are retail. And we can see back here how retail called the rally and institutions got out of the way. We're seeing how retail is buying and institutions are selling. So if we take a look at this and we drill out and we go, okay, well, let's take a look at this over a year. Who would you have rather been? Well, if I look at this, I would much rather have been retail, because retail was calling the bottoms and you have institutions that were selling the bottoms, right? I would rather be in a position where I am not selling the bottom, but buying the bottom. And it's incessant. So the way that they're calculating this and showing that, quote, dumb money, what they're not really showing is they're not showing how the pension funds and the large people are investing, right? They need to segregate this out a little bit better, the way it's calculated, because this is showing that you're at a bottom, because that's when they get out of the market. They get out of the market at the bottom. That's what, quote, smart money's been doing. And when is, quote, dumb money or retail getting in? At the bottom. You need to take a look at this and understand that there is so much money on the sidelines, not only in cash or money market accounts, but also on the ability of them to use margin debt. Took me a long way to get there, but that was the point that I was trying to make, that the amount of money that's out there, once we're through this, if it's a decent number, and I have my opinion, but that doesn't really matter. What's going to matter is the number. And, are they going to revise another number? We never know. The new game lately is that they revise things about 30 days later. So you can see how we're wedged in here, and you can see how this is playing out. And then you start looking at these other sectors and going, okay, well, here's XLK forming this beautiful, right, cup and handle, in my opinion. We're not perfectly triggered yet, but it's there, okay? So you start running through these and then going, all right, so what else do we have? Here's XLK, and we're unable to break through that XLK level, right? And that's definitely one of the core things that I'm looking at, trying to figure out, are we going to break through or are we not going to break through? And we're going to find out tomorrow. Now, one of the core things that we've been looking at is the Qs relative to the SPY. And before we get into some of the names, I think we're better off getting into the names than anything else, because again, this is going to change. It's important to understand that we are rejecting here again at the relative performance level. We're going to have to blow through this in order for this rally to continue. If we don't blow through this, then we're going to be stagnant to down, and that's not really where we're going to want to be. Now, you can see the risk premium trade is on here, where they're buying Bitcoin. They're buying risky assets, right? They could say, well, this isn't risky. We all know that when risk is on, what do? You're buying Bitcoin. We could talk about the volume for sure and how it's anemic, but that also means that you don't have any sellers, which is kind of interesting. So this has potential and can continue to grind. One of the key names that we were trading with stock and options in the Alpha Chasers community was MSTR. If you don't get the newsletter, there is a free version in the link below, and there is a wait list if you're interested in joining. But you can see how we popped right over that level. Now we fill in that gap. So the next level I'm really looking for is that 362, but it was everywhere. And you're starting to see this more and more. Look at what you're seeing with the RIOT and some of these short positions. These guys are just getting squeezed and they're getting absolutely crushed. And reason I'm pointing out more stocks today is because tomorrow when you go through this, it's the stocks that you're going to have to watch right when CPI comes out. And you're going to have to watch how they act. Understand the news, understand what we went over today, because the numbers that I gave you and the way to play them is the most highest degree of probability on what's going to happen, right, on those moves. But we don't know that. So you want to watch the action in the stocks. And I'd be looking at these names in particular that we're about to go over. But we did see some things that were pretty interesting today. For example, Homebuilders. Goldman had a note. It wasn't that great. It certainly wasn't that rosy. CFRA had a note on it. It was good. It was talking about that there could be a boom. And okay, so it was decent. But why are you moving ahead of CPI? And we saw this everywhere today. We saw all these names moving ahead of CPI. And I find that very interesting. That wasn't huge volume, but all of a sudden we're starting to get these reversals in these names. And the only reason that you would start seeing people buy these kinds of names like Toll Brothers, THMC, you can even see this with Beazer and see what's going on right there, right? You can see how these names are setting up to break out. Why are they setting up to break out now? Well, the only reason that they would is because you think rates are going lower, right? Because if rates go lower, that's going to fuel the housing market. There's other reasons why housing stocks are going to go a lot higher, but the number one reason is just supply. We're short like 6 million houses. But if you cut rates or rates drop or we're towards the tail end of that, then people know that, okay, I need a house. Now it's time for me to go and get a house and move in. And that's what you're going to start seeing happen here. And I think that's really very important. So let's focus on this and let's focus on that level, and then we'll go from there. Now, this was another name we bought around $24. I want to just let everybody know this. When you watch social media and you were watching social media 2-3 years ago, everybody seems smart. It's because you're in a multi-decade environment where you couldn't be wrong. So you're starting to see people write these bear reports as if they know what they're talking about when they really probably haven't been trading for 5 years. You need to be really careful of what you're reading right now and where you're getting your information from. So this company in particular, they align themselves saying, quote, AI, automation, however you want to talk about it, it's automation. They're linked into Walmart and helping with the automation. Stocks hitting all-time highs, right? You don't want to be somebody that's shorting this because of the, quote, AI craze. You need to understand what you're shorting. We started buying this at 24, started looking at it at 23. Once we started getting through this level, the back test, the rally, and then I just waited for a trigger, got it, and we've done quite well with it. So be really careful, but this name, it still has legs. And this is what I mean. You're in a stock picker's market, whether or not you want to believe that. That's what you're in right now. And that's actually a good thing. It's actually a lot of fun. So if we go here and we take a look at WW International, right? We just take a look at this and go, well, geez, we were just at $4 and now we're at 6. And let's just show you where we went to, 689. Huge short position. What is WW International? Well, Weight Watchers. Why is stock doing this? Goldman Sachs came out and issued an entire piece on it. Their target was 3. They put a target of 13 on this name. It's at 6. You have 100% still. I can't stress enough that if you start doing some digging on not just technicals, right? Talking about this moving average, that moving average, that's fine. But if you know this stuff and you start doing some digging, there are gold mines like this everywhere. This was something that a bunch of people did in the trading community today and did well with. And frankly, we had a fairly good day today, considering how slow it was, just because of the names that we were in and how we were positioned. This WWE is still so misunderstood. And we started buying this around 85, 86. Don't roll this out. Make sure that you do get the newsletter so that you can follow along. But if you see this, look what happens when you came down. You came back down and you're testing. And it's this kind of stuff and understanding where you can make a difference. Okay, you can make a huge difference in the portfolio. This was another one that we bought. I'm not really up on it that much, but I want you to get this. When we knew that they were going to come out with a secondary, and because good news, they have zero, right? They don't make any revenue. So you're going to issue stock so you can fund the company, right? Even if you have cash, you're still going to raise more cash. So when they did it, and we saw that it was oversubscribed, we knew that it was a great time to get in and get involved. And it's worked out. Now look at this flag. What do you think the opportunity is here tomorrow if CPI is good? I think it puts us in a really good light. And I would look at these names. So I know we can sit here and we can go over the Teslas of the world and these kinds of names, but it's all going to be one big trade tomorrow. I would personally tell you to focus on semiconductors because I think that's where the money's going to go first. If I look at these charts, which to me look like they could absolutely rip on good news, I don't know that we're going to stop at these levels tomorrow. I think that you could have a really very powerful move tomorrow dependent upon how bullish that number is. Even if that number is a little hot, I'm not so convinced that the 25 basis points from May 3rd is not baked in. So we focused more on stocks tonight. There were several names to go over. I wanted you to get a better picture of what's going on. The bottom line is me going through technical levels today is kind of pointless because they can change. They can change in a heartbeat.